Welcome everyone. Today we're presenting on the PJCC Inquiry into Corporate Insolvency, and I've been so lucky and fortunate today to have Dr. Jason Harris, one of the co-authors of the Keys textbook and also a professor at University of Sydney. This is a big coup for us. I've been trying for many months to get him on board to be a part of our presentations. Unfortunately, with some of the timing, my fault. We weren't able to do this as a proper LinkedIn Live session, but instead we're going to have this as a recording for everyone to go through and see at a different date and whatnot. So thank you so much, Jason, for agreeing to be here today. Very grateful.
Thanks for inviting me.
So basically what these educational videos are that SV partners and I are putting together a bunch of videos. Most of them have been done through LinkedIn Live now, trying to give free educational content to people as it relates to corporate or personal insolvency and some other broader issues around potentially forensic accounting and some other different types of laws. So you'll find a lot of our videos and that on our website at svpartners.com.au or on our social media pages, including my LinkedIn, which is under the Matthew Hudson hashtag there, or hashtag SVVoidables. So what I'd like to quickly do now is just introduce or let Dr. Jason introduce himself. And I get to call him Dr. Jason given he's now just recently received his doctorate. So massive congratulations on that. I know that's been a bit of a long slog for you, but congratulations.
Thanks very much. And I'd like to take the opportunity to thank members of the insolvency profession who helped me during that 10 years that I was doing the thesis.
Well, I unfortunately haven't had the chance yet to read the thesis, but I did note that it does get referred to quite a bit in or at least in a few different situations in the PJCC Inquiry. So I do intend at some stage to read it. I have read a couple of your colleagues' theses recently on some of that stuff. So I look forward when I get some time, but I will get there. What we're talking about today is the corporate insolvency law reform that was brought in, that's being discussed in the Senate at the moment. They've got this inquiry on the go. It started around about September 22. They called for submissions. So far, we're sitting at about 76 submissions received, from what I can see. There are some people that have been given the opportunity to do multiple submissions or various annexes to that. But overwhelmingly, there's been a massive response to this. It's broad range from what I could see. Jason, do you agree with that? Yeah, it's not just insolvency practitioners or just lawyers. I've noticed it's from quite a broad range of people or stakeholders across the country, even quite a few charities or mental health organizations and stuff like that. So I think what has been submitted on the whole has been really good, and I hope the Senate can fully use a lot of the information they've been given. There's also quite a few government departments, and I actually noticed in your when you appeared in front of the Senate, Jason, they even referred to the fact that you referred to the fact that ASIC had actually put up some new data that you hadn't previously seen. And so I think that's a really good positive outcome that came out. That I hazard a guess to say that might have helped a little bit with your thesis even. So I think there was some good submissions put out there. Where we're at the moment, from what I could see, that there were 5 public hearings that have been held, and part of the reason why I wanted to get Jason to talk about this today is he had he was fortunate enough to be invited to appear at, I think it was the first public hearing from
Yeah,
them.
down Canberra.
Yeah. So he appeared with Michael Murray, who's the other co-author of Keys textbook, and so he had the opportunity to go through and present to the Senate at that time. So we wanted to talk to him today, get a bit of an idea of where he sees the lay of the land with that inquiry, and where we might be heading and stuff like that. So we've got a few things that I want to go through today. But I think probably one of the more interesting things to come out is that there's only about 2.5 weeks to go until they're meant to submit their report. So 30 May is supposedly the deadline. Have you heard anything different? Do you have any suspicion that it might get pushed out?
No, I haven't.
Yeah.
I mean, that's the deadline when they're supposed to table it before the Parliament.
Yeah.
I should note it's a parliamentary joint committee, so even though it's got a lot of senators on it, it does also have members of the House of Representatives.
Yep.
This particular committee on corporations and financial services is one of the standing committees of the federal parliament, and their remit basically is to look at corporate law. How's it working? What does ASIC do? Are there areas for corporate law reform? And over the years, it's conducted a number of inquiries that touch on insolvency. This is the first time it's looked at insolvency in detail in probably at least 10 or so years. But there have been previous inquiries on ASIC, for example, the conduct and registration of liquidators. So this particular committee does have a bit of experience with corporate insolvency.
Yeah, so I think what I'm probably most looking forward to is to see what actually comes out in that report, what might actually be something that we could debate and talk about, which I think probably will lead us into our first major topic, which we'll get to shortly, which is this idea of a root and branch review, which a number of people have been calling for a long time. Yourself and Michael certainly have been doing that, and no doubt ARETA and other bodies. So I'm really looking forward to reading that report whenever it comes out. I'm sure everyone's more busy with the budget from last night than anything else. So, but we'll wait and see what happens there. But what was your thoughts from having appeared at that inquiry? Where do you think? What was your overall thoughts about all that? And do you have maybe a key message for the PJCC or even just the profession itself, who are all probably, if I can just add one little extra to that, is there's so much material up there on this inquiry, and a lot of professionals in that are maybe too busy to keep up to track with everything. Is there maybe a key theme or a key message that you might be able to convey to everyone about maybe what's been going on, or your thoughts about that?
Yeah, sure. So one thing that I was pleasantly surprised about was that the committee members do seem really well informed. So one of the challenges we have in enacting meaningful solvency reform is that, as we all know, it's a very technical area. It's a technical area of practice. It's a technical area of the law. There aren't many politicians who've got experience with insolvency, restructuring and turnaround processes. There are some, but there aren't that many. We don't seem to have a real champion in Parliament who's pushing for meaningful reform. So just trying to cut through to the politicians and their advisors about why effective insolvency laws are really important and valuable. What's the value proposition of having good insolvency laws rather than ineffective insolvency laws? We hear through the media a lot of negative stories about insolvency, and the statistic that the former Senator Wacker Williams used to roll out, in some survey of the public trust in different professions and occupations, insolvency practitioners were ranked at the bottom, even below politicians, and he used to roll that out whenever he could. But my concern with that is that it's part of this kind of negative feedback loop that we have through the media. So the only time the media reports on insolvency stories when there's some sort of scandal. Employees have lost their jobs, maybe there's been some fraud or something like that. Fortunately, we haven't had many cases of serious fraud in the insolvency profession over the last 15 or so years. We've had a couple of cases, but in a large profession to have 2 or 3 cases in 15 years How many solicitors are there serious fraud cases? How many, doctors, dentists, engineers, or whatever are there serious fraud cases? So just being able to cut through with that message of this is a really important area for the economy, this is a really important area for finance, it's a really important area for real people who are running businesses, and that we shouldn't just sit back and assume that everything's working. We should periodically, think critically about, is this working as intended? Is it achieving the goals that we want from the system? And a huge problem that we see in insolvency, really policy and reform, and which comes through in so many of the submissions, is the patchwork of data that's available. We don't have a comprehensive, up-to-date data set that is publicly available. You mentioned the ASIC statistics that were put in ASIC submission, but I'd also point out the statistics that were provided in the ATO submission, in the FEG submission. So there's a lot of valuable data out there that would allow us to actually shed some transparency about how the system is working. I think the fact that we actually don't know on a system-wide basis what outcomes we get in insolvency. We know how many companies go in, we know how many appointments there are. We've got the the Schedule B style reports of, well, here's the estimates of the assets and the deficiencies, and what the estimates of remuneration, the estimates of secured debt, but that's really all we have. So the annual administration report data we don't get, and that's really the key data. We've got a system here which is so important to the economy, and we don't have really basic data about how it works. So one of the things that Michael Murray and I were putting forward in our written submission and also in our oral submissions to the committee was that, before we go through and do a holistic review, we really should do some sort of evaluation of actually how is the system working. We're all working in this system, myself as an academic observer, you as a practitioner, no doubt many people who are watching this video. We're all working within the system, and we all, have particular things that we like and don't like. What we don't have is this holistic view of how is the system as a whole working. So not how do you think liquidations could work better, or how does a trade supplier think preferences could work better, but actually, why do we even have preferences? Why do we even have liquidators? What Michael and I talked about in our submission was really there's some big picture threshold questions that we need to be looking at here. Why do we have insolvency? What is it trying to achieve? We can point back to the Harmer report back from the mid-1980s and say, well, that looked at some of those issues, and for its time, that was an excellent report. And there's still a lot of great value in the Harmer report, even all these years later. But what I would say, and I know what Michael has said many times in public, is, that was 1988. How much has business and the economy and society changed since 1998? And we really haven't had a detailed review of insolvency since then. We've had some kind of patchwork inquiries along the way that have looked at particular things, but really it's been a theme of reactive inquiries. There's a scandal, someone's complaining in Parliament, ASIC's getting grilled in Senate estimates or something, and so there's an inquiry into that, rather than actually, let's do a full stock take here and look at how is insolvency working, what is it trying to achieve, and are those goals achievable? One of the things I'm sure we're going to talk about is the funding of insolvency practitioners and the returns to creditors, or really what we should be saying is the lack of returns to creditors in most cases. One of the terms that I used with the committee was what I say is a market failure in insolvency. And really what I meant by that was we have a system that is premised on an external profession basically doing a large chunk of their work for free. And I just don't think that's appropriate or sustainable. If we're requiring practitioners to do work, they should be paid for it. If there's not the money in insolvent estates, then there should be funding from the government for that, because really it's work in the public interest. I'm glad to see that we're having this inquiry. I was very sceptical at the start, because with any of these parliamentary inquiries, the investigation period, the reporting period is so short. The Harmer report took years to be completed. So having a parliamentary inquiry that's going to take place over months, and a couple of those months are the Christmas January period. is it's never going to be able to get across the material. And what I was really pleased to see was that the members of the committee were fully across that many of the submissions and many of the people appearing before them made that very clear. It's great that you're doing this. It's not enough. We need to have a holistic review of insolvency law.
Do you think that what probably will most likely come out of this report is that they make the recommendation for this review, this holistic review, and that there'll be maybe 3 to 5 low-hanging fruit items that they could just quickly tick off, so that they can try to tout it as this big win, etc.
That's right.
Yeah,
There's some very common problems that we're seeing through a number of the submissions. I mean, probably the one that really stands out the most is the trust issue in insolvency, that really something should be done about that. My concern with seeing that as low-hanging fruit is it's a really complicated issue. So it's not something that hopefully it's not something that we'll just see they tweak a provision in the Corps Act and say, oh yes, here's what insolvency practitioners can do with trust assets. That's not going to fix the problem. It's broader than that. But that is really the one that just stands out. That was recommended in the Harmer Report. There's a whole chapter in the Harmer Report from 1988 saying you need to do something about trading trusts and insolvency. So we've known about this literally for decades, but it's a complex problem. It's a mixture of state and federal law. There's a lot of policy issues in there. I mean, there's a lot of political issues in terms of who is it that uses a lot of these trading trust structures and family discretionary trusts and these types of things. So it's a really complicated issue. I don't think we can just see that as low-hanging fruit, but that's the most obvious one. The other ones would be things like fixing up some of the reforms that were introduced in haste. So in the fact that simplified liquidation really doesn't work, the fact that small business restructuring, even though it's picking up, it's got promise. But I mean, in the first 2 years of small business restructuring, we had something like 200 appointments. We had 200 appointments of voluntary administration in like the first 3 months when that was introduced. So it really hasn't taken off like voluntary administration did in 1993. That doesn't mean it's a failure. I myself thought it was going to be a white elephant when it was introduced. There's aspects of it that I think really don't work very well and could work a lot better. But that's something I suspect, given that they've had such detailed feedback about those procedures, that could be something where they would come out and say, okay, yeah, let's remove this requirement, or let's make this a bit more flexible. Maybe let's lift the debt liabilities threshold in that to make it more accessible or something. So there's some little things that they could do there. I wonder if they're going to do something about preferences. There's a lot of people very unhappy about preferences. So even though I'm not necessarily convinced of the case for changing preference laws, I mean, by all means, simplify it, clarify it, help make it easier to process, maybe make some of the enforcement actions a bit easier on preferences. But I'm not necessarily convinced that we should say just completely do away with them, or restrict them to random monetary amounts just to appease certain sections of the commercial finance and trading community. But it wouldn't surprise me if that happened. Like, there's been so many people complaining about preferences, particularly on the creditor side, that I could see a politician thinking, well, that's going to get me some brownie points with the business community if I come out and say, okay, you can't bring a preference claim if it's under 40,000 or something like that. I'm not suggesting that, but it wouldn't surprise me if the committee recommended that based on the submissions that we've had.
And I have actually read quite a few of those submissions who are attacking unfair preferences, given I absolutely love them.
You might be the only person in Australia who would say that, Matt. I love preferences.
So I would say on a lot of that I could do a whole video dedicated to rebutting a lot of the stuff that was said in there. But look, I think my feeling is that I think it's quite crazy for someone anyway to be trying to go after a trade creditor unfair preference for, say, less than 30 or 40 grand anyway, especially since the recent High Court case in relation to the running balance account defence and stuff like that. I think that does cause some issues for liquidators anyway in running trade creditor preferences. We're not seeing a huge amount internally ourselves anymore. It's obviously a lot more about government agency related unfair preferences probably tend to be a little bit more at the forefront now. But yeah, you're not seeing those massive mothership proceedings anymore. back in the day, you'd have a liquidator would identify maybe 50 potential creditors. They'd run off to court with one filing fee and do what's called a mothership proceedings to combine all those creditors together. You don't see that very much anymore. Like I would have said, it's been probably 3 or 4 years since I've seen probably a decent one done like that. It's
Right.
not as common anymore. And I think that's really off the back of the running account defense, the uncertainty on set off, and then also all the COVID restrictions and all that was placed on us. So, look, I just think that everyone's, if I could call it whinging about unfair preferences, I think has been a bit misplaced given, all the other things that have gone on in the background anyway, but for it. So, I just think that it shouldn't be tampered with at this stage. I did read some of the submissions from a reader around the unfair preferences and some of their ideas on some of the reforms there. They suggested that the burden should be reversed when it comes to related parties. I really like that idea. I think the amount of resources we have to spend just to prove avoidable transaction against a director, for instance, I think is just overkill. Especially when in many instances that I find, directors are not upfront about things at all. They'll try to potentially hide, some of their related transactions and whatnot. So, I like that suggestion. One of the suggestions in there that I did have a bit of a quick laugh about was they suggested that the minimum amount should be $4,000 to tie in with the stat demand. So I thought I can't really imagine too many situations in which someone's going to be running off against a trade creditor for $4,000 as an unfair preference. But I have seen it once many years ago, about 8 or 9 years ago. I think someone tried to sue someone for about $6,000, and that creditor actually came and saw me about it because I was even mind blown when I saw it. So, but I don't think that stuff happens too much anymore. But I'll digress for now because we do have quite a bit to get through. But basically, what are we going to go through today is about five different topics, and we want to flesh out some of the key things that I could see within, in particular, your transcript submissions when you were appearing in front of the PJCC. Some of the themes that I took out of it, and also some of your answers to questions on notice and stuff like that. So, I want to go through a little bit of that. And I think also there were some comments made by some of the PJCC committee that I also would like to touch on, because I think that some of them are a little bit inflammatory, and I just think it'd be nice to maybe point that out to some of the profession in particular who probably don't have the time to read them and may not understand some of the context. So the five main topics that we'll be talking about today is this concept of a root and branch review, which we've already briefly touched on. I want to talk a bit about the greater role the state could play, particularly when it comes to all these deregistrations that are happening, and the idea of a corporate insolvency government-run liquidator potentially, or even better funding as it involves a liquidator. And then the third area I want to talk about is remuneration. So when you read these transcripts over the 5 days, and that it's just constantly remuneration all the time. So I think that's a really important area. I think we'll probably spend quite a bit of time in there. I want to talk briefly about these new reforms from the small business restructuring and the simplified liquidation. I want to keep them quite. I don't want to go into too much detail, but we'll touch on that a little bit, and then we'll talk a little bit about these trust law reforms and some breaking news from overnight from the budget in relation to that. So we'll come to that shortly. So just going back to the root and branch review. So it's been long advocated that we need this holistic review of everything. I think a lot of people, when they think about that holistic review, they think about it more in terms of, we want to see everything all joined together. So you have personal and corporate insolvency all put together, and, we'll have this one legislation, one government department, and, everyone will just get on with their lives and we can go from there. But that's certainly not necessarily the scope of yours and Michael's views, from what I could tell. That it should be a bit broader than that. So do you mind maybe just touching a bit on what your thoughts are there?
Yeah, sure. And I guess the starting point would be, I'm certainly not speaking for Michael Murray.
Yeah.
So these are just my own views. Um, that I think there's a lot of value in trying to bring the system together. I mean, we had the Insolvency Law Reform Act back in 2016, and that has a provision that says, oh, well, it's supposed to harmonise between the personal and the corporate systems. The personal and corporate regulators are supposed to work together on things. My impression that hasn't really worked.
No.
The processes that we see in the personal regulator take aren't necessarily the same as the processes or the approach, indeed, that the corporate regulator takes. There's massive differences between those two regulatory agencies in that ASIC is this kind of everything regulator in terms of its regulatory remit. So there's just so many competing priorities that it has on its resources and focus that it is really quite a different regulator to AFSA, albeit AFSA also running the PPSR. So having a harmonised system where I personally am in favour of a single regulator, but I would note that there are other countries around the world that have a unitary system. So there is an Insolvency Act, but there are still separate regulators for personal and corporate insolvency. And you can be a trustee in Canada, for example. You can be a licensed insolvency trustee, and having that designation means that you can do both personal and corporate, as opposed to our system where you've got to be effectively double registered. So I see a lot of value in that. Me personally, I think we should have an insolvency office, an insolvency regulator's office that handles both personal and corporate, that registers practitioners for both personal and corporate. In terms of a government liquidator's office, that's a related but a slightly separate issue. So the concern, and this I know that Michael and I do have similar views on this. The concern is that the system we have at the moment, both at the personal and the corporate level, is chronically underfunded, and it's underfunded because people don't generally go into insolvency procedures when they still have a lot of assets. They leave it to the last minute. They trade the business into the ground, and it's really only when they're forced into insolvency that they go and seek an appointment. So the starting position is there's not enough money to pay everyone. I mean, that's the definition of insolvency, right? You don't have enough money to pay all your debts as and when they fall due and payable. So how are we going to deal with that problem? How we deal with the problem in personal insolvency is we say, well, there's the official trustee in bankruptcy, and if you can't get a private trustee, for example, because you're broke and you don't have any money to pay them, then you can still access the insolvency system, and the government trustee will do that work. Some of those matters are referred out to private trustees for particular purposes, and I know a number of private trustees are not happy with that process, the kind of the quality of the files that they get referred out. I also know that
if I can add maybe just quickly on that is I have noticed quite recently, probably over the last year or so, there's been a lot of very, very small referrals out from the personal insolvency regulator, and some of those should just have been kept internally because it's just impossible to for a private enterprise to run some of those files. So, and I think that's a bit of a function of it's so tough at the moment in the employment market to retain staff and to find people to do this type of work in particular, and to get them to go into even a government agency and do that type of I don't want to say menial, but not the big exciting appointment type jobs. It can be a bit difficult, and I certainly can appreciate their lack of resources and stuff like that. So, but yeah,
I detect that there has been a change in approach within the personal insolvency regulator, that I think they do want to be referring more matters out. They see, that this is the sort of thing that a private profession should be doing and not the government doing. But a broader question here, and what Michael and I say really is a threshold issue, is, how should we be dealing with these low asset and no asset type jobs? Like, we're operating on an assumption that the way that we have done it for the last several hundred years is the way to do it. That's not the case in many other countries. So in many other countries, if you've got a low asset or no asset job, it's just an administrative process. Like, there's nothing to see here.
Yeah.
If we think there's significant fraud, okay, that's for law enforcement to deal with. That's not for the insolvency service to fix. So we have this approach that, we're assuming everything gets investigated. Every matter is going to be thoroughly looked at, and there's going to be a report, and something's going to happen. And what we know is, in most cases, in fact, in almost every case, nothing happened.
Yeah.
So I've phrased it as busy work, because it's work that we're requiring to be done that really has no consequence. Now, I suspect if Michael was on this call, he might say something like, well, there's kind of a respect for the rule of law issue here too. That if we just sweep everything under the carpet, if we say, well, this is an administrative matter, there's nothing to see here, there's no money, is that going to cause creditors to change their behaviour because they suspect something's going wrong and maybe there's been misconduct and nothing happens? Now, my response to that would be, that's already happening, because liquidators are referring thousands of reports every year to ASIC, and ASIC looks at a tiny percentage of them and actually takes action. So we already live in that system. It's just my own view here, we pretend like we have this full transparency, full investigation. I've referred to it in some of my papers as the Rolls-Royce insolvency system. We're starting with no money, and yet somehow it's a magic pudding, and we can do all these sorts of things coming out of it. Now, the practical consequence of that approach is that IPs have to work for free. And both Michael and I think that is totally inappropriate. That if we say that this work should be done, whether it's work that is going to generate a tangible return to creditors or not, maybe some of this work is purely in the public interest. It just should be done. Okay, the government should pay for it then, because that's public interest work. What other profession can we point to where we say, 2 days a week you're working for free because it's in the public interest? That's outrageous.
None, and neither would no politician. So
no, neither would university professors. So that's what I mean when I said in my public statements that this is market failure. We've got a system that cannot pay for the work that it requires. So Michael and I have been suggesting that where a government kind of official receiver's office should come in, like they have in England, like they have in Singapore, for example, like they have in New Zealand. And the role of that government liquidator's office could be to actually do some of the work, or it could be, funding the private profession to do some of that. But we say that the current system really is untenable. It's not appropriate that highly qualified professionals are having to work, 10, 20, 30, I've seen estimates as high as 40% of their work, particularly on things like official or court-ordered liquidations, for free. That's just totally inappropriate. So we need to change that system. The other thing that's
free, though, it's not just free, though. It's also they take on speculative. There's a lot of speculative work that comes through. So it's generally on the basis of, I think I'm going to get potentially some type of recovery from this other source. So I'm going to go spend 3 to 6 months of my energy and resources to try to go after whatever that is. And that claim could be an insolvent trading claim. It could be some debtor dispute that's going on in the background. It could be some assets that have been moved and stuff like that. But there is a big lead time, a lot of WIP days and stuff. So normally when you run accounting firms and that, you'd be trying to keep your WIP days as low as possible. Insolvency practitioners and that would be running at many months lead time before their WIP and that's collected. So it's sometimes it's not even just that it's free or anything like that, which I think I saw in some of the numbers. It was like they think it could be up to $47 million a year of free work. But on top of that, it's the speculative nature of even the fee paying work a lot of the time, or even the delay process in getting some of that money paid. But I just wanted to quickly touch on two quick things that you did mention just then. So one of them was in the ASIC, when you lodge your 533, so that's the investigation report that's prepared by the liquidator. So the 533 attaches to something called this EX01. I didn't name that, so don't blame me, but that's what the document's called from ASIC. You lodge that document, and ASIC's actually been called out in these transcripts around it was taking like 10 seconds, 12 seconds for some computer program to go through, do its magic, and work out if it wanted to investigate. And there's no appeal process to that. So if it spits out saying that they don't require a supplementary report, they don't require any further information from you, it's actually quite a difficult process to get someone to relook at it. I for one had a major fraud matter that made my blood boil every time I would look at the matter. I'd continuously keep trying to tell ASIC and them about it, but you just get nowhere with it. And so that's probably one element that I have noticed lately has changed. So no longer do you get this 10 to 30 second response. We're finding it's now taking until the next day at least till it comes back. So that's actually one nice positive outcome, I will say, from the process. And then the other thing I just wanted to quickly mention was you're talking about the need for a government-funded liquidator because there are going to be jobs out there where there really is no money in it. It should just be an administrative process. But that's what we hoped the simplified liquidation would be. You could fill out, for instance, the annual asset return statement, and you fill out that, and that's effectively acting like the report to creditors. And there's no need to vote on remuneration in that because it's all based on fixed fees or something like that. And you try to do it as absolutely bare bones as possible. Obviously, there's going to be conditions and stuff around that, but you want to try to keep it as simple as possible. And the simplified liquidation process is not that at all, but which we'll come to a little bit later. But I just thought I'd quickly mention it because that's what I hoped the simplified liquidation would be. But
in my view, the problem that we're having here is, and I see this almost as a uniquely Australian problem, is that we're trying to meet multiple policy goals through the prism of insolvency. So much of what we're looking at in terms of the narrative around insolvency, the public narrative, what gets reported in the press, what politicians talk about, is concerned with fraud, basically. Picking up on fraud, Phoenix activity, dodgy pre-insolvency advisors, criminal activity, money laundering, bikie gangs, drug gangs, all these types of things. So when we introduce insolvency reform, we're saying that we want the reforms to be quicker, faster, cheaper, and hopefully more effective. But actually what we're doing is we're saying, but not if it comes at the cost of making phoenixing easier or making money laundering easier or whatever. And so I think we're really trying to achieve inconsistent goals here. That insolvency law is not focused and shouldn't be focused on dealing with these other law enforcement issues, which is not to say, well, let's just make insolvency as easy as possible and someone else can worry about the problem of money laundering and Phoenix activity. But I don't think we're going to stop Phoenix activity through insolvency law. So the idea that, well, if we have all these different checks and balances, then that's going to make Phoenixing much harder. I'm not sure that it will. People are going to break the law. So having laws isn't going to stop people breaking them. What we need is more effective enforcement of those laws to try and discourage those who can be discouraged. There's always going to be a criminal element that will break the law, whatever the law is. We have countries around the world that have the strictest laws possible in terms of punishment. Yep. People still commit crimes. It's going to happen. But this idea that we can use insolvency law to deal with those problems, I just think we're kidding ourselves. So what we end up with is really a suboptimal solution that doesn't meet any of the goals that we're trying to achieve. We still have people who are doing the wrong thing, and we still have insolvency laws that are too complicated, too expensive, and not fit for purpose. So we should focus on what insolvency law can do well and then help it to do that. And then focus on laws that are directly targeted at the sort of conduct that we want to discourage and do that. Don't try and make simplified liquidation an anti-Phoenix tool because it's really bad at that.
Yeah, and I think that sort of lends into the idea of just how easy it is at the moment for people to just simply deregister their company. Realistically, there's two ways to deregister. One is you fill out a form and you sign a declaration saying that you have below a certain level of assets. I can't think off the top of my head what that was. I think $1,000 or something, and you have no liabilities. Or secondly, you just don't pay your ASIC invoice, wait 3 to 6 months, and they strike you off. Doesn't matter if you had unlimited number of assets, unlimited number of liabilities sitting in that company, it can get deregistered and potentially you just keep going on your happy way. And yet we have quite strict, as you say, Rolls-Royce insolvency laws And we're trying so hard to stamp out all of this bad behavior and all that through the use of insolvency. But yet we've just completely turned a blind eye to hundreds of thousands of deregistrations. It's mind-boggling, and there's just very little data about those deregistrations either. I've always been amazed that when the ATO registers your tax, for instance, for a company, it actually registers it against the ABN, not the ACN. So what I find interesting is that there should be a simpler data match there between the ATO and ASIC, where they can go, okay, I'm sending out a strike-off action, and it should feed straight into the ATO system, and they go, well, hang on, no, this company hasn't lodged all these returns, or there's all this outstanding tax, and then ATO can get on with what it needs to do to wind up that company or do whatever. Like, it should just be a far more streamlined system, rather than just allowing people to go off and deregister willy-nilly or just don't pay an invoice for $100. To me, it's just always been crazy.
And the committee picked up on something that Michael and I said in our submission and also in our testimony about the fact that the deregistration figures just dwarf formal insolvency.
Yeah.
So, I've actually put this in our submission. So I went back to the insolvency notices website, and all I did was look at all of the notifications about deregistration. So both the ASIC initiated and the voluntary deregistration. And I literally just listed them all, went to the last page, calculated the total number via the number of years. And, on average, we're looking at in excess of 160,000 deregistrations over the last, 12 years since that website became operational. We've never had more than about 14,500 corporate insolvencies in a year in terms of formal external administrations. So the figures of deregistrations just dwarf formal insolvency. Now, the members of the committee picked up on that, and they then started asking people in subsequent public hearings, why is it that 12 out of 13 companies that get into insolvency don't use insolvency because they're being just deregistered? Now, some of those deregistrations will be a follow-on from a liquidation, but not that many, not 100,000 of them.
No.
So that's a problem, and this is why Michael and I say we need to start this reform process by saying let's not just try and fix what we've currently got, because maybe what we've currently got really isn't fit for purpose anymore. So what are we trying to achieve? If we say that there's maybe 200,000 businesses going under every year, what should we do with it? If the large proportion of them have no assets? Should we have a private profession that's engaged in that process? Should we have the government engaged in that process? And what's the balance of that work look like? What are things that private profession perhaps are uniquely qualified to do and far more efficient and effective than government offers? And I'm not sure it's everything. I think there are some things that the government possibly is better at doing, particularly on a mass scale, than a private profession. But no doubt there are things that you and your colleagues are far more qualified to do than a bureaucrat standing in Canberra. And we need to have that discussion. Actually, what can be achieved in insolvency? Because just put everything in the law and saying this is the way we've always done it, everything gets investigated, everything gets reported on, let's have a meeting for everything, which no creditors turn up to, let's prepare voluminous reports that no one ever reads. That system isn't working. I've described this, we're all living in mutual fantasy that insolvency works. And no doubt it works in individual cases. No doubt you've got files where you can say, this is working well, we're getting good outcomes for stakeholders. But how many matters do we have where we can't say that? The problem is we don't have enough data to know the difference. We don't know what the outcome is. We don't know what it costs. We don't know how long it takes. You know how long your files take, and another practitioner knows how long their files take. But on a system-wide basis, we just don't have that visibility because the data is not there, or rather, ASIC isn't releasing. So that's what we need, better data.
Yeah, no, I agree. I've been screaming for that better data as well, so it would be nice. And even when it comes to the Assetless Administration Fund, I'd like to see a little bit more data from there as well. You can troll through and have a look at some of the points around how much they're releasing and stuff like that. But, I think, a better idea to firstly have a lot more funding through there, but also a bit more data there that we can try to understand what are some other avenues or other ways that we could be utilizing that resource to progress our investigations or to progress our files and stuff like that. But
I think that fund is a complete failure.
Yeah.
So the origin of that fund was in the Harmer report, where they talked about, the fact that there are insolvent estates that just have no money. So there needs to be a system to deal with that, whether it's an administrative system that deals with it or whether it's an external system that deals with it. But there needs to be some funding for that. So the idea that we have an assetless administration fund that, really is ironically named because it's not appropriate for assetless administration. Many practitioners tell me it costs almost as much in work time to make an application as you get in the funding. So it's not an assetless administration.
And the funding is not retrospective. So you do all that work to apply for the funding, and then they make a decision on, yes, okay, we'll give you the funding. And then you got to fill out a form that's very similar to the one you've already filled out just to get the funding. And it's just like, well, why did I spend all that time doing that? So, and they don't pay you for any of that. So, yeah, it's a bit haphazard.
And I'm really disappointed with what's happened with that fund over the years. So it used to be administered by ASIC. And then a couple of years ago, I don't know if it was an ASIC-initiated a thing or whether it was a Department of Finance-initiated thing. It was then basically transferred to Department of Finance, and it's now seen as a Commonwealth grant. And what that does is it gives ASIC a very convenient shield or buffer for criticisms about how that fund is doled out. So when ASIC was running the fund, we can say, well, why aren't you paying more? Why aren't you loosening up terms? Why aren't you making it easier to use these funds? That's what they're there for, to deal with assetless administrations. Now ASIC can say, oh, that's a matter for government. That's not us. That's Department of Finance. We don't set the rules. That's the Department of Finance. And that may well be correct, but I think that's bad policy because for Department of Finance, this is just one tiny little, $5 million allocation a year in a multi-billion-dollar budget. That's not going to be their priority. Again, brings us back to the start. This is why we need a dedicated insolvency regulator, someone who does care about these things, as opposed to this is just one item on a very long list of things that we've got to do.